Welcome, everyone. And I'm going to throw a challenge out there. Over the first two presentations in person, the one that we had in Alpharetta yesterday and in Buckhead 2 days ago, the number of questions and the sophistication of each of those questions was pretty impressive. And I kept thinking to myself, I'm glad Eric Kramer's standing up there answering those questions. So he did a really good job. So I'm expecting this group to bring their A game. But I want to just introduce myself as CEO of BIP Wealth, and normally I give some commentary about the firm and how things are going before turning it over to Mr. Kramer, our Chief Investment Officer. And the highlight that I really wanted to focus on is that we've expanded our presence geographically into the Nashville, Tennessee market. And so we have hired now a personal wealth advisor by the name of Ashley Arrington, and also a relationship manager by the name of Sydney Warren, who's going to be working very closely with Ashley, but Sydney will probably also be working with some of the advisors in the Atlanta market also. But we're real excited about expanding into Nashville, just a tremendous growth opportunity. We already have about 20 families up there that we work with, along with a venture capital firm called FinTop that we've already invested in a couple of their funds. So got a good network and really just a great opportunity all the way around. So with that, I'll go ahead and turn it over to Mr. Kramer, our Chief Investment Officer. And he has promised just a fantastic presentation about globalization, and looking forward to your questions later on in the presentation. Thank you.
Thank you, Bill. I appreciate that introduction. I'm going to do my best to live up to those promises that you've made. I remember asking you a question yesterday that relates to our expansion. How many different states do we have clients in these days? And so how many states is that now?
So we've embarked on 37 states, and we 37. Have a presence here in Atlanta, Nashville, but we also have advisors located in Columbus, Ohio, and Scottsdale, Arizona. So we're continuing to grow geographically and really, you know, one reason why we're able to do that is that our clients are just fantastic and have been very generous in the referrals and introductions to the firm. So that allows us to spread our reach across the country. So thank you.
Sure. Well, in today's presentation, we're going to talk about our 5 key themes for 2022 to get started. And unfortunately, they all seem to be coming true. So they were accurate predictions. Then we're going to get into the market recap and then talk about our outlook. So let's just jump into the 5 key themes here. And the first one is that stock markets will struggle, and I'm going to show you the numbers. They certainly have, even though we've had some good news here in the last month. The second one is that public fixed income will suffer. That really has to do with, I think, the Federal Reserve's mismanagement of inflation. We've predicted extreme volatility at any time, and we haven't quite had the type of volatility in the single day that I expected, but we've had some pretty bad weeks back to back, and so I think we've seen that as well. We said that tax rates may not increase because nobody wants to pay, although there is some news that some corporate tax increases, or at least a minimum that corporations will have to pay might actually happen this year. That's probably a good thing, but I don't think we're going to see tax rate increases on individuals. And then the 5th topic would be that private markets can play a larger role for a lot of folks. When I show you some of the damage that's been done in the fixed income market, you might remember from prior presentations that a lot of, for instance, the private market fixed income that we're investing in is having very stable double-digit yields, and so the contrast between the public and privates will become evident there. So we'll touch on all of these as we go throughout the presentation, but let's go ahead and jump into the market recap and share some of the bad news. The theme of the last quarter is that the speculative frenzy has reversed, and there might be no market better to illustrate that than the cryptocurrency market. So let's talk about what we're calling the crypto crash. So I've got a chart here that shows you what's happened with Bitcoin in particular that we're going to get to. But let's just take a little trip back in time first this is a slide that I showed you all a year ago, and we asked 10 questions. These are actually the 10 questions that our investment committee has been charged with attempting to answer. What I'll say is that a year later, we've still not been able to answer those. One of those questions, the one that I've highlighted in red here, was, could we justify a decision to put client money into cryptocurrency if the asset class were to fail completely? And that hasn't quite happened, but let's take a look at the chart of what has happened with Bitcoin in particular. And what you'll see is that over the past year, it's been extremely volatile, and in fact went up since last year at this time when we began to ask those really difficult questions, and then just got on a slide downwards. And so the average investor in Bitcoin right now and the average investor in cryptocurrency right now has actually had a loss of value. People that got in much earlier are still up, but we've come down from more than $65,000 a coin with Bitcoin to, we got down to just under $20,000 a coin, I think, in one particular moment in time. So there's been this gigantic sell-off in cryptocurrency. But I've been doing this job long enough to see fads come and go, and one of the phenomenon that's kind of consistent is that it's really in the later days of an investing fad when you see these last sort of desperate attempts to make money off of that. And we're seeing that in the cryptocurrency market for sure, because we're now adding, we think, about 1,000 cryptocurrencies per month to the total. And so we're now at over 20,000 different cryptocurrencies. And I want to explain why real quick. It's now very, very easy to create your own cryptocurrency. So a few of us could get together, download the software, pay a modest fee, create our own cryptocurrency. And the playbook here is well known. It's well documented. It's easy to see, but it's not stopping investors from putting their hard-earned money into this. You can create your own cryptocurrency. Perhaps you withhold 90% or more of it for yourself, because you get to make all these decisions. The actual float in the cryptocurrency is just a tiny percent of the total. And you get a few social media influencers or sports stars or other people to decide that they're in to promote your cryptocurrency. If it goes up and gets the attention of the folks that look at this kind of stuff every day, then it might take hold. And all you need is a few folks to pay attention to it, to post about it, and then it takes off. But again, the folks that create these cryptocurrencies are really the ones that own most of it. So if they can get the price to be bid up enough, then they can unload their coins and make millions or hundreds of millions of dollars in rapid fashion. And then they're just waiting for it to collapse. They don't really care. They're not invested in it at that point. And since it's so easy to do, you've got all these folks hoping that they can catch a little bit of that. So, I'll just ask every person listening to this to use your common sense and answer the question for yourself. Do we really need more than 20,000 private currencies? And I'll differentiate what's going on in the crypto market from what's going on in the blockchain market. As I'm sure many of you know, blockchain is an underlying technology that I think is with us to stay as we see advancements in computing to the point that current safety and security protocols are inadequate to protect financial transactions. You'll see blockchain being rolled out more and more, but developing blockchain technology does not require that you attach a currency to it. So this explosion in cryptocurrency is just nothing for the most part but a con job by people trying to get a little bit of your money. So who knows, in 10 years, we might have a handful of cryptocurrencies left, and maybe they do find a valuable role in the global marketplace. but we definitely don't need 20,000 cryptocurrencies. So at some point, I'm confident in predicting the vast majority of those are going to disappear. What damage that does to people's net worth, what damage that does to the global economy remains to be seen, but this is clearly unsustainable and just has reached the point of being absurd. Looking at this next slide, you might immediately ask yourself, well, what does this have to do with cryptocurrency? What I'm showing you is for the last quarter, for the second quarter of 2022, the market returns of different countries around the world. And you'll see the global index there in the middle being down about 16%, and the US right there in line with the global average. The US is in red, the global average is in blue. But look to the left part of the slide and look at what country did the best: China. Now that may be a bit of a surprise because you probably know that major portions of China keep getting locked down due to the explosion in the COVID Omicron virus variants. But China is a little bit unique among all these countries in that they have outlawed cryptocurrency. They've done it in stages. It started with outlawing the mining of cryptocurrency because that's an environmental disaster. Massive amounts of energy being consumed for very little end result there. And now it's moved into any financial transaction or even owning cryptocurrencies. So China has really been the leader at getting rid of this speculative frenzy and not exposing themselves to it. And so in a quarter when cryptocurrency was down quite a bit, you actually see the best country returns in the world coming out of China. Now, two countries that you don't see on here are El Salvador, which adopted Bitcoin as an official state currency a little over a year ago. That turned out to be pretty bad timing. And then I think most recently, the Central African Republic joined El Salvador in adopting Bitcoin as an official currency, even though fewer than 5% of their population even has access to the internet. So this whole market for crypto is just full of fraud and promises that are not going to be fulfilled. And I hope that if any of you are choosing to invest in crypto on your own, that you're making sure that the amounts you put into it are modest and within your loss tolerances, as we say. As we move into the major capital markets in the US and around the globe, what you can see on this slide here is how the benchmarks have done. So at the top is the US fixed income benchmark, and at the bottom is the global equity benchmark. And that reflects how a lot of folks invest, including ourselves, where your fixed income is primarily US based, dollar based, but your equity investing goes around the globe. There's a lot of investing to be done outside of the US borders. In fact, this past quarter, investing outside the US did a little bit better than investing inside the US for equities. In the last 3 months, the global equity index was down almost 16%. Now, we don't invest by indexing in that way. Our clients actually did a lot better, and I'll share some of that relatively good news here in a moment. The US fixed income index was down 4.69% after falling a little bit more than that in the first 3 months of the year. So now the year-to-date numbers for US fixed income for the index are down double digits. And that's new stuff for the markets. We're setting records for how bad it can be, but it is one of the risks that we predicted, that public market fixed income would suffer. We've dealt with that by trying to own much shorter term bonds that are in the index, because then as rates rise, the rate that you get out of that resets very quickly, as opposed to having bought, say, a 30-year bond where now you're locked into, a low submarket rate of return for the next 29 years after rates go up. So what we saw with the global equity index was worse from an absolute standpoint, but still within the realm of most of the experience of investors on this call. What we saw in fixed income was a lower loss, but is setting new records for how bad it can be. So actually it's the loss in fixed income that's more worrisome than the loss in equities. And many of you I'm sure received the write-up that we did about the positive impacts of what we're calling globalization 2.0. And actually here in July, so far, I think the global equity index is up about 10%. So we've already had a pretty good recovery from that. As we look back at the last 12 months of that global equity index, you can see that we're holding our own for the last half of 2021, and then 2022 has not been good news. The downturn was bad enough that when we look at that long-term equity chart there, you can see it. Sometimes that's the test. It'll look like bad news in the short run, but you look at a long-term return and you can barely see it. But we can see that downturn. Down 20% is significant enough that it does show up on a long-term chart. And as we look at all the headlines over the last year and wonder which ones were maybe the most important, where was the real bad news? What caused this? I've isolated that down to what I think are three headlines that really carry almost all of the blame for this downturn. The first one there is that the president will nominate Jerome Powell for a second term as the Fed chairman. So Jerome Powell was nominated by the former president and then renominated by this one. He actually took office again for the beginning of a second term this spring. But I think that Jerome Powell has mismanaged the inflation situation just so badly. There were so many signs, and we were pointing them out in these quarterly market reports we really have for a couple of years now, that the problems were around the supply curve, not the demand curve. And the Federal Reserve's tools all really have to do with demand. And so they really kept their foot on the gas, created this runaway inflation, despite what was happening with Russia and Ukraine, despite what was happening with the pandemic. And now are regretting that and trying to reverse policy. And in fact, those two things I mentioned are the two other reasons that we've had this big downturn. Russia invading Ukraine and starting a war there has had massive impacts on the global supply chain in all sorts of ways that have to do with agriculture, that have to do with energy, that have to do with resources used to make computer chips and all sorts of things. So it's a really, really big deal. And of course, the third one, the pandemic, the headline we'd all love to be done with is just not going away. There continue to be new mutations, and it's variations of the Omicron mutation, the so-called BA4 and BA5 that are now raging around the world, including even in this country. Thank goodness it's less deadly, but China's reaction to that, its zero tolerance policy, means that major parts of China's manufacturing base continue to get locked down, including even news this week that part of the Wuhan province where it all started is being locked down. Another 1 million people can't leave their homes for some number of days as they try to stamp this out. I think at this point, these variations are so virulent that this is kind of a lost cause, and unless we get some much more dramatically effective vaccine that we can use, this is going to make its way into China. So we don't know if they're going to reverse course and cure a lot of the supply chain problems tomorrow, or this is going to be something that they're implementing for years to come. But it's definitely one of the big causes of the downturn. Now we're going to move through a bunch of data, and we're going to do it kind of quickly. This is really just the big picture slide where we look at all the major asset classes that U.S. investors put their capital into. It's all red arrows, so there's no good news here. And we're still talking about the indexes at this point. It's worth calling out, I think, that we didn't set any new records for the scope of the downturn this quarter, but on the fixed income side of things, the worst prior quarters in the last 2 decades were just last quarter. So with the U.S. bond market being down 4.7% this quarter, that sounds pretty bad. If that would have been a new record if we weren't down 5.9% just last quarter. So a lot of these records had been from the Great Recession, 2008, 2009. But some of the news has been so bad this year so far that we are setting new records for being bad. So I just always like to put those up there to remind people how good it can be, how bad it can be. So we're not setting new records this quarter, but I think we've now accumulated enough bad weeks and bad months that we can check the box to say that that prediction for extreme volatility has definitely come true this year. As we talk about the US market, which is now 60% of the global equity index, what we see in the top right part of this slide is that BIP wealth's overweight to value helped to mitigate the loss. So the overall market was down 15 to 16%, but our focus on value helped some for folks. And there's lots of individuals and even lots of advisors that are still maintaining an overweight to growth. The pain was a lot more severe. So those small cap biotech companies, those large cap tech companies were down closer to 20%. And there's many instances of individual companies that were down 30 or 40%. So a lot of pain to be had on the part of other folks, not the ones listening to the call right now. Fortunately, we had that value tilt, which gave us exposure to dividend-paying companies and companies that have commodities as part of their asset base and things like that. Went down, but not as badly. And we see with international developed markets, so think of Europe and developed markets all around the globe now that have markets that function as well as the US does. On the whole, the exact same phenomena. Value didn't go down as much, growth went down more, so the value tilt helped. And then in emerging markets, what we'll see is the same thing. Value didn't go down as much, growth went down more, so the value tilt definitely helped. Now, this next slide, where we talk about real estate, is very interesting. That's only 5% of the equity exposure for our clients. That's our target, and most all of our clients are right at that. But this is the asset class that maybe generates the most questions. And when we're investing in real estate, it's very diversified. We have a tilt to the US, which has worked out over the years, as you can see with the table at the bottom. But let's think of all the different ways that you're exposed to the real estate market. Now, when we're meeting in person, a lot of folks are happy when they come to our offices to see that there's plenty of parking spaces. And that's because commercial real estate in the US that's oriented around office space is I think going to have some real challenges because a lot of people are working from home. I think that's very definitely the new trend. As we'll see later, the labor market is very tight. If you're the company that says everybody has to show up here in person, you might rightly be worried about losing employees to more flexible employers where people can work from home. And so there's a good chance that office rents are going to need to come down. But warehousing and retail, multi-family residential, think apartment complexes, Wall Street's even figured out how to invest in single family homes. All those parts of the real estate market are doing great. And when you're in an inflationary environment, really all real estate tends to appreciate in value because of that. So again, some challenges with rent, but most other parts of the real estate market are looking fairly healthy. And while single family homes are not a very big part of this at all, most folks listening to this own a home. And I do get asked a lot, is it time to sell our home? Prices have gone up a lot. And the answer is, I don't think so. I don't think we're going to see inflation suddenly go away. And even though transaction volumes are dropping because of rising interest rates and rising mortgage costs, I think that price appreciation will continue. So I don't think there's some reason to dispose of your real estate. And in fact, owning a single family home can be one of the best things to have on your balance sheet right now. As we look at the non-equity parts of capital markets and focus instead on fixed income, we see a slide here with a lot of data. And I'm just going to call out a couple of things that I think are the most important. And the first is what we call the Treasury yield curve, which is that top middle graph that you see there. The light kind of green line shows you the interest rates that the market offered for Treasuries 1 year ago. The next line up is just 90 days ago, and then the top line is where we're at now. So what you can see with the June 30th line is that if you're buying a US Treasury, you're going to get about 3%, whether you buy a 1-year Treasury, a 5, a 10, or a 30-year Treasury. 3% is kind of the going rate. Now, the 1 year and under rate is a bit lower because that is being anchored by the Federal Reserve's interest rate policy decisions and the overnight rate. So we did just have a 75 basis point increase in the overnight rate this week. That brings it up to about 2.5%, so not quite up to 3. But when you see that kind of bend in the curve, what it tells you right away is that the Federal Reserve is late in its actions. The market has already settled on about 3% and predicts that the Fed will get there and is just waiting for the Fed to do it. So again, the Fed is playing catch up here. You shouldn't really see a bend that severe in the curve. It just means that if there's rates being set by policy, that they're falling behind where the market has already gone. It's also worth looking at the bottom of this slide at the two parts of the fixed income market that BIP Wealth has historically not invested in. And that would be the junk bond market, because there's a lot of volatility there, and the long bond market. Again, the long bonds might be if you bought 30-year Treasuries, and you can see that year to date, that index is down over 21%. Again, rates go up and you own a long bond, you've got a bad deal to live with for a very long time. So of course the price falls. And our overall philosophy about public market fixed income is that we want to focus on capital preservation and stability. I think most folks need that anchor in their portfolio to some degree. If you're going to take stock market-like risk, you better be expecting stock market-like returns. And as you can see from looking at the last 10 years for both junk bonds and for long bonds especially, the returns have not been anywhere near what the stock market has offered. So again, stock market-like volatility for very low returns doesn't seem like a good trade-off to us. And so our clients are not exposed to the junk bonds and not exposed to the long bonds. I've shown commodities here because even though we're not investing in commodities directly, our clients have indirect exposure to commodities because of the value tilts that we apply to investing in the stock market. So again, value stocks tend to be more stable. They have predictable earnings. They actually have earnings. Not all growth stocks even have positive earnings. And so that is going to necessarily include a lot of energy companies and so on. And so this rise in the price of certain commodities that we've seen over the last year or two has definitely benefited our investing approach. But what I'm showing here on the slide is what we call the spot market. And so spot prices have now begun to change. It's the first time in a while that I've been able to show a commodity slide where it wasn't everything going up, but we've begun to see industrial metals and precious metals and agriculture sell off. So the spot prices have begun to sell off. Now, when investors try to put money into the commodities market, you can't really buy the spot market. You have to buy what's called the futures market. And there's problems with investing in that. It's one of the things that has kept us from putting investor money into commodities, despite the fact that we were worried about inflation. Instead, we just made sure that we maintained our heavy tilt towards value in the stock market, and we got our commodities exposure in a much better way, I think. But this is a signal that I think inflation has probably peaked, and we're beginning to see a sell-off in one of the drivers of inflation. Of course, that's the raw materials here. So that's the past. And now we're going to talk about the future. And the headline, Globalization 2.0 is coming, is going to be one that we flesh out with what I'll admit is a lot of very interesting facts. It's going to tell a story of a market in conflict, a future that has not yet been decided. But you're going to leave this section of the presentation with a whole bunch of bits of information that you can impress your family and friends with when we're done. So let's jump into this. The first slide I'm going to show you is one that I've been showing quarter after quarter here now, and that's retail sales. And what you see as we go through the last couple of decades is that in the last 2 years, retail sales have gone up at a rate that I'll tell you is unsustainable, but it's quite surprising. It's been a symptom of the health of the economy and why there's still an underlying strength to our economic situation now, despite whatever recession headlines you might have been reading. Now, when you see this spike over the last couple of years, you've got to ask yourself, well, why did that occur? And I'm gonna offer some circular logic there. So when the Federal Reserve is printing money, when the Federal Reserve is keeping interest rates ultra low to stimulate the economy, you create a problem from that, and that problem is inflation. So if all of us on the call today are worried about inflation, we're going to accelerate our purchasing. Inflation is not bad for economic growth per se. And in fact, when we're worried about inflation, we accelerate our purchases, we move them forward. And so that has stimulated retail sales. Now, you have a problem here with these hiccups in the supply chain, these problems with COVID in China, these problems with Ukraine. When the supply chain gets broken, suppliers of these retail goods can't keep up. And so they begin to raise their prices in response to this extra demand that the Fed has helped to create. And so you ask yourself, well, is the rising retail sales creating the inflation, or is it the inflation that's causing this boom in retail sales? And the answer is both, and that's why it's a spiral. When retail sales take off and then you get inflation, they're self-reinforcing. And so we've just seen this rocket ship continue to go up. So if you want to know what worries the Federal Reserve right now, it's how do you look at this growth knowing it's got to end, and somehow get it to end with what we call a soft landing. So again, I think inflation has peaked. As the inflation comes down, that's actually going to cause the demand for retail sales to soften a little bit. Again, we're not as worried about inflation, so we can put off that purchase of the new car or the new washing machine or whatever it might be a little bit. And then as that eases, then prices will come down. And what we expect is that inflation will moderate. We won't go into deflation, but how fast that occurs is really the trick. And if we see retail sales fall off dramatically in a very short period of time just to get back to the long-term trend line, that's probably a recession, and maybe even a severe one. If it trickles down slowly, then that's the soft landing. And again, despite the headlines of recession, I'm going to show you some GDP numbers in a minute. I don't think we're actually in recession, and maybe won't even have one, but that's what the Fed is focused on. So let's look at the inflation numbers, the ones that are different from what you've probably heard about. You probably heard about the consumer price index being up over 9% in the last year. And for many of us, 9% is the real number. But the Federal Reserve likes to focus on something that they call personal consumption expenditures. So the number is less, but it still means we're having inflation. And we just had some new PCE numbers come out that show that they're kind of staying in this range. So I think they've peaked. I think they're coming back down a little bit, but I do think long-term inflation will continue to be much higher than the 2% number that the Fed has had at its target really for quite some time. So I think may have peaked, but will continue to stay up, just not go up anymore from where they're at right now. When we talk about gross domestic product, and we're going to talk about that for a few slides, we have to realize that GDP is a lagging indicator. Instead of looking at GDP to figure out where we're at right now, I like to look at something called the weekly economic index. And if we look at the data over the last decade and a half here, what we'll see is that the weekly economic index really tells us what GDP is. And the weekly economic index right now is still positive. We're at about 3%. Now, gross domestic product numbers get announced And we recently saw it announced that GDP was slightly negative, but that's going to get revised down the road, and then it's going to get revised again. And I won't be completely shocked if the number moves up a little bit. Again, the weekly economic index moves up and down a little bit. You see a little bit of noise in that series there, but actually I think that's a much more current measure of what the economy is doing. And it looks at a lot of different things. I showed them listed there on the slide, but that is still positive. So if you ask me, are we in a recession right now? My answer would be no, we're not. Going back to GDP for just a moment, because eventually we're going to get accurate figures. What we can see, thanks to the Congressional Budget Office, that's the CBO, is that GDP really couldn't grow from where we're at. The orange line is the CBO's potential for GDP. Now, we got slightly above that potential line right before the Great Recession, and then we had a recession. So the economy was just too hot. So I really don't want to see GDP get above that line. What I like to see is us growing at our potential rate. So, it took us 7 or 8 years after we exited the Great Recession to get back up to the line, and we were about to go over it in 2019 when the Federal Reserve, for no good reason, began adding to the money supply and lowering interest rates. They didn't know the pandemic was about to happen, and once the pandemic was here, increasing money supply and lowering interest rates for a short period of time did make sense. But that 3 or 4 month recession ended, and then they continued that stimulative policy, and that was their big error. But we've seen GDP recover rapidly. Now we're sort of bouncing off that maximum potential GDP growth rate. So 1 or 2 quarters of the GDP falling off a little bit is actually very good news. If we were seeing it go back above that orange line, then we would not be seeing what I think is peak inflation. We would know that that problem is going to be even worse. Instead, we're seeing GDP measures do exactly what we want them to do, which is to stay a little bit below that orange line, have there be just a little bit of slack in the economy. But the orange line can't go up any more than it is because of problems with productivity and problems with people. So let's talk about productivity and people here in just a minute. On this next slide, what you'll see is that productivity over, well, that's really ever since the end of World War II, is on what seems like an inexorable climb upwards. So that's due to a variety of technologies. And, it wasn't that many decades ago when big office buildings would have entire floors of typists creating paper memos because that's how people communicated. Of course, that's gone, and there's 1,000 other technological advances that have added to productivity. So productivity grows, but often grows the most when we're in a recession because companies become short on resources. They figure out how to get more out of less. Now, it looks like productivity growth has stalled a little bit during the pandemic, but we might be about to write some new history here because we have a problem with not enough people. The economy is actually so strong for so many firms and so many industries that we can't get enough people. And so we're now doing the thing that we normally have to do during a recession. We're looking for efficiency gains for the next year. What can we do? How can we get more out of our limited number of people? Again, normally it's the recession that creates that big jump in productivity. We might be able to get a jump in productivity as all these smart capitalists go out there and look for ways to deal with what's really a big problem here is a labor shortage. So this is going to be some interesting history that we're about to write in terms of productivity. So because of all the things that I've mentioned to you right now, and I keep saying it, I don't think that we're in a recession. I don't think we're about to go into a recession, although that is, still to be decided by, among other things, Federal Reserve policy. What I've graphed here is stock market returns, which are in red, and you can see the fall in the stock market. and the Federal Reserve's probability estimate that we're going to go into a recession. Now, this is updated monthly, and the July number says that the probability of a recession is 0.5% right now. Now, these gray bars that you see in this timeline of history show you when we've been in a recession in the past. And you can see that the stock market has fallen many times when we did not go into a recession. But a recession as measured here is not 2 quarters of negative GDP growth. Again, I'm actually kind of happy that GDP growth may have mitigated a little bit. But these are recessions as defined by the National Bureau of Economic Research, which is a private nonprofit group that declares recessions under some different metrics and, frankly, some professional judgment that they throw into the mix. They usually do it after the fact, but they've certainly not declared that we're in a recession. And again, the Federal Reserve says, looking at all the data that they measure, we're not about to go into one. One of the reasons is that the labor market is so incredibly strong. In every other recession that we've had, people are losing their jobs in droves. Right now, there are almost 2 open jobs for every person looking for a job. Now, this is a chart here that offers one of those helpful curves that the Congressional Budget Office, the CBO, has calculated for us. That's the green line. And that says how low can unemployment get? Well, what you see is that we're below that line. We're below that potential line. So the natural rate when the economy is firing on all cylinders is for unemployment to be down to about 4.4%. And instead, we're measuring it at 3.6% right now. So actually, the labor market is too strong. We are short on workers. And I'm sure there are folks watching today that are running businesses that have the responsibility of hiring people, and you know how tough it is to hire good people right now. So the labor market is incredibly strong. If we actually end up in a recession, it's going to be the first recession where everybody that wanted a job had a job. Now, sometimes there's some question about the data, so I'm going to parse that out a little bit on the next slide here. One of the things that we look at is the participation rate. So here's what I mean. There's been a narrative over the last couple of years that says people just don't want to work. You may know that that unemployment rate we just showed you is how many people are unemployed among people that want to be in the labor pool. So you could, in theory, have a very low unemployment rate if a lot of people simply don't want to work. Well, the measure of how many people want to be in the labor pool, those that have a job or want a job, is what we call the participation rate. So if we look at all the adults in the United States, actually it's everyone 16 and over, and say how many people want to be in the labor pool, that's the participation rate. And right now we're at about 62%. Now you see that potential participation rate declining over time because of demographics. There's an awful lot of baby boomers that have retired. There's folks in their 70s and 80s now, and they don't want to be in the labor force anymore. They don't need to be for the most part, and they're not going to come into the labor force. So this declining curve is really a function of demographics, but among our population, you know, that could be in the labor force, that's about 62%. They pretty much all are. So this is not a story of people not wanting to work. We are really at our maximum participation rate. And even with that, the unemployment rate is barely above 3%. One of the reasons that we are so challenged for workers right now is that population growth has stalled. And make no mistake, absent some major productivity gains, some new technology that reduces the need for people, this is a problem. Population growth in the United States is declining, and it is following the exact pattern that we've seen in Japan, in Germany, basically in every westernized democracy, but even in China now. The one-child policy has been abandoned because they're becoming worried about not enough population growth. You can have over 1 billion people, but know that you're not getting the kind of growth that you need. So more and more countries around the world are seeing their birth rates decline and their population growth stall. And as people live longer, generally, you need more younger workers coming into the system to pay taxes. So people always ask questions about immigration policy, and that can be a very big discussion. But just given where we're at right now, at least with legal workers, we're running out of them. A couple of the reasons for this are that the birth rate is declining. And again, that's completely normal. It's not evidence of some other larger problem. In every country around the world, as the standard of living rises, the number of live births drop. So over 100 years ago in this country, the average woman had 7 live births. 2 of them died in infancy and 5 lived, but that was 7 total. And that trend of that birth rate declining to now around 2 or less has played out in every one of the countries that we've been able to track this data in. 20 or 30 years ago in Africa, almost every country still was having 7 live births, but actually the majority of those have dropped to closer to 2. So there's still a few countries around the world that are at the 7 number, but this is really a global trend, even to the point that now we can more reliably calculate what the maximum population of planet Earth is going to be, where it's going to peak and then begin to decline, just as it's starting to do in developed countries. On the next slide, we'll see what I hope is a temporary kind of a thing, and that's that the death rate has actually climbed. And of course, that's due to the pandemic. So as the pandemic has threatened the health of the elderly primarily, we have seen the death rate go up. So if we can get to the other side of this pandemic, then hopefully the death rate can actually go back down. But you've got a declining birth rate, an increasing death rate, and a super strong labor market because of all our economic growth. And that together tells you the story of why we don't have enough workers. So now let's talk about globalization. Globalization 2.0 is the name I've given to what's coming, but let's just talk about globalization as we all understand it. Globalization in some ways is a bad thing. It has caused the loss of more than 7.5 million manufacturing jobs in the United States over the last 4 decades. And the reason is that goods get manufactured where they can be manufactured the cheapest. This has led to some other bad consequences, such as countries with weaker protections for workers, working 6-7 days a week, working very long hours in unsafe conditions. That's common and gets funded by this pressure. Also, it can be bad in that there are many countries with weaker environmental laws that cause pollution that affects the whole planet. So globalization has definitely had a bad side. It's also had a good side, as different countries have different advantages. It might be natural resources, it might be cheaper labor costs. There's a whole host of different advantages that different countries can have. It's meant that goods have been produced increasingly wherever they can be produced the cheapest. Now that has led to consumerism in the United States, which again, that's not all a good thing, but it means that the cost of living has really fallen in real terms all around the globe, and in particular in this country. The boom in public storage facilities is just one bit of evidence that many of us own more things, own more stuff than we can even fit into our houses now, because it's become so cheap to do so. And that's been a function of this globalization. And this deflationary or disinflationary pressure, as economists like to call it, has meant that as long as capital can flow, as long as those containers can move back and forth across the ocean, often coming from Asia to the US full and then going back empty, as long as that happens, then then the cost of many things that we buy in life is simply declining. So the Federal Reserve was able to engage in a cheap money policy. The Federal Reserve has been able to print money and not have to worry about inflation. It's the reason interest rates have fallen and inflation has been low for decades and decades and decades. Except for now that natural disasters and disease and war have broken globalization. Suddenly those container ships are not moving around the world the way they used to, or even when they can move, they can't be filled by the manufacturers in China that allow globalization to function as it's functioned for the last half a century. As we look at some of the case studies that I'd like to call out here around the globe, we can see some of these problems with people and goods. Let's look at airlines for a minute. Certainly within the US, the airline industry would say we're having our best year ever. In some ways, demand is through the roof. The economy might be slowing in some areas, but it certainly is not in travel. The demand for air travel is at all-time highs now. So, United is spending huge amounts of money to hire new pilots and to expand their pilot training. American has actually had to abandon service in 4 cities in some popular travel states because they simply could not meet the demand. This is not a problem with fuel costs. This is a problem with more demand for travel than this industry can possibly satisfy. There's been some interesting news from Delta lately, and I always like to mention Delta if I'm going to talk about airlines, since of course that's close to home. There was so much congestion at London's Heathrow Airport that the airport shut down travel. It said the airlines have simply overbooked, and Delta had to send an airplane over to bring back over 1,000 pieces of lost luggage just to get them back to US travelers. As a result of that, most recently, Delta was offering passengers over $10,000 each to give up their seats because they had overbooked flights within the US. So you're really getting some crazy stories now coming out of the airline industry because the airline economy is so strong and the demand is so great. Let's switch to Tesla, a headline producing company like no other, thanks to Elon Musk. He recently said that overwhelmingly his concern is, how do you keep factories operating so that we can pay people and not go bankrupt because of what's happening with the COVID shutdowns in China? So again, this is the pandemic shutting down globalization. Tesla cannot get the parts that it needs. He was quoted as saying that Berlin and Austin factories are gigantic money furnaces right now. And he talked about how in Austin, they're going to make the Model Y SUVs using certain battery technology, but the tooling required is stuck in China. They can't do what they want to do because, again, the container ships are not rolling out of China because of the shutdowns around the pandemic. He said that the past 2 years have been a nightmare for supply chain interruptions, one thing after another, and we are not out of it yet. So the rate at which these problems get cured is going to determine whether we go into a recession or if we do, how fast we come out of it. Let's go to a company now that you might be less familiar with, although they're huge, and that's Daimler Truck. And they make trucks wearing the Mercedes-Benz badge, Freightliner, Western Star, Thomas Built, and frankly, a handful of others as well. Their CEO is named Martin Daum, and he's also been quoted as saying that they're facing enormous pressure on the supply chain to the point where they're having to touch trucks that they've built 3 or 4 times to add missing parts, that they've got 10,000 trucks sitting around waiting for 1 or 2 parts that need to put in. So the truck's been made, it's rolled off the assembly line, it's parked in a massive parking lot full of other almost finished trucks while they just wait for parts to be shipped from around the world, and they can't get the parts because globalization is broken right now. So he says in the United States alone, there's pent-up demand for 200,000 trucks, and that they hope to catch up with those supply shortfalls that they've had to deal with the last couple of years. And then I got to laugh at the last quote I'll list here. He says he's actually optimistic that it will not be too bad in 2023. And since he's German, he says not too bad is a German expression for it. It actually could be good in 2023. So here's a company CEO who's very optimistic about the future if they can just figure out how to solve the problems with the supply chain. And so let's talk about that. Solving these problems is what I'm calling globalization 2.0. So a couple of key points. First is prices will remain high. Companies are going to accept higher production costs in exchange for greater control of the supply chain. And insourcing, meaning bringing production back to the US, is one of the main ways that they're going to do this. So yes, we have a tight labor market, but more and more companies that are selling to the US are going to try to bring production to the US, something that many car makers did to some degree decades ago, but they're going to do it even more because they don't want to have to wait on a container ship to come across the Pacific Ocean or the Atlantic Ocean to bring them the things they need if they could make it 5 miles away. So as they do this, they're going to be developing alternative plans. They're going to be signing contracts with suppliers, and the costs are naturally going to be higher because it was this globalization that was driving costs to be so low. Now, there will be things like 3D printing and other advanced manufacturing technologies that solve some of this. And at some point down the road, many of the inputs for advanced manufacturing are going to be created right there by the same company. It won't be that another company makes it and ships it to them. They'll simply make it themselves through these advanced technologies. Timelines for production may be slower. When you're making it yourself, you've got to figure out how to do that and manage your own pipeline. But this might be what I'm calling the death of just-in-time inventory. In the past, if you could have a container show up outside the factory 6 hours before the car seats were needed to go in the SUV, and they always showed up, that was time. Instead, we might have to slow things down a little bit. It can't be just in time. And again, it might have to be from insourced production. And lastly, expect what manufacturing has been talking about quite a bit, running production changes. You may go into your GM dealership and look at the printed paper flyer for or brochure for your new SUV, and it may talk about all the features that you're going to get. But more and more manufacturers of every type of product are warning their customers that the feature set's going to change, the specs may change. They're going to have to roll with these problems with globalization. And so you might not get the heated mirrors, or you might not get the other fancy things that you wanted. It might be different types of batteries in the electric vehicle than the ones you thought you were going to get as they respond to these challenges with the supply chain. That's the new future. And every single company out there that manufactures anything is having some of their most important strategy meetings right now to make sure that the problems of the last couple of years are mitigated and not repeated. So we've talked about an awful lot today about what's going on in the economy. So let's pivot for a minute back to how we invest money. Everybody knows that you can put money in cash, you can buy fixed income, you can invest in the stock market. And fortunately, all of our decisions around that have resulted in benefits to our clients. But there are a few other things that we do. There's some strategies that we execute using options to take away risk. That's the hedged yield and the hedged equity. And I'm listing these tools in the toolbox, if you will, in order of risk, with cash always being the safest investment. And then you'll see private equity on the end. We've already talked about private fixed income, and in a year where the first half of the year resulted in a loss in the public fixed income index of about 10%, and investors in private fixed income are used to making 10% a year with their yields. you can see that the gap there is enormous, but also the gap in private equity is enormous. We've had a terrific experience with our clients over the years with their investments in private equity. Again, private investments are illiquid, so we say that they're the highest on the risk scale. Certainly our experience has been a little bit different, and our experience has definitely been that that's where the highest returns have been. So in listing all of these tools in the toolbox, my point is to say, when each of you meets with your personal wealth advisor at Buckhead Investment Partners, they're going to spend a lot of time learning all about you. You might not need the same tools applied to your portfolio that somebody else needs, but it's the combination of this very full toolbox and the unique circumstances in your financial life that your wealth advisor is working so hard to reconcile, to say to you, I think you ought to do a little bit more of this. I think you ought to do a little bit less than this. And here's how we think it's going to give you more return and less risk. So just to wrap up, and then we're done, we've got these key themes for 2022. They're not all rosy predictions, and so far it looks like they're all coming true. I think that speculative excess has been punished, maybe not completely gone out of the market. Cryptocurrency has jumped back up in the last week. You'll always see something out there that still needs to be punished at this stage in a downturn. I think that inflation will moderate. It's going to set a lot higher, but I think that it's possible that inflation has now peaked and will gradually come back down. I think the job market's going to stay tight. So if you have a job, if you're looking for a job, if somebody in your family is going to graduate from high school or college in the next year or two and be looking for a job, these are probably really good times for them. And it's one reason that we might not be headed for a recession despite the headlines that you read. And as I say here, I don't think that a recession is imminent, and the Federal Reserve right now agrees with me. And lastly, there's a bunch of tools in the toolbox. We just talked about that. I'd encourage you, whatever concerns you have, please talk to your personal wealth advisor. They've got a set of toolbox that other advisors at other firms can only dream of having. So I think that there's a lot that we can talk about and a lot that we can do for every single one of our investors, no matter what your personal circumstances. And so that's it for today in terms of my prepared remarks.
The timing of that is impeccable. So job well done. I know we're a few minutes already over the 1 hour mark, but happy to take a few questions. We have a couple that have been added already to the queue. One of them came in at 12:03. So I think that's the quickest we've ever received a question. And this one comes from Don. So Eric, do you agree with Jim Cramer's recommendation? And you have to say if you have a relation to Jim Cramer or not. But do you agree with Jim Cramer's recommendation that now's the time to be getting back into equities because the Fed is signaling that they are beginning to reduce their interest rate increases?
Thanks, Don, for that question. No relation to Jim Cramer. And, there was a time in Jim's career where I didn't want to have any association with some of the things that he was saying, but he's actually earned a lot of credibility back over the last decade. And in fact, I do think that he's right about this. In fact, I felt so strongly about that at the beginning of July that we issued this piece about globalization 2.0. And if you read through all of it, your invitation to this quarterly market report was about 3 times longer than it normally is, because we wanted to make that point. We even sent that out as an email separately to say, hey, we've put this on a 2-sheeter, please read through this, because there's so many voices out there talking about a recession. But the stock market starts to go up typically even before a recession is over. The stock market and the economy are not the same thing. So I think that with everything the Fed is trying to do, and where I think we're at with COVID, where I think we're at with China, right? Those are 2 awfully big variables. The time was right for us to start to get back into the market a month ago. So we got that message out. We made sure that for our clients that were underweighted to equities versus their target, which most were because of the downturn, that we were stepping in and buying equities. And we wanted to make sure that our clients were not so scared by the headlines that they that they asked us not to invest. And I'll have to say, I'm very pleased that that I think the message got through. So we wanted to make sure that we got that message out when we saw the signals changing there, which was about a month ago. And I think that the markets are up about 10% just in the month of July since we sent that out.
Thank you, Eric. Thank you for the question, Don. Next question is from Lee. How do the rounds of layoffs announced through 2022 figure into this picture of low employment and the battle for talent?
That is a great question, Lee. And the headlines have picked up, headlines about layoffs. Now, the employment market, of course, is not monolithic. There's many different parts of that. So what we're seeing is a pickup in layoff announcements, but the overall labor market is still incredibly strong. I'll give you some numbers to chew on. A couple of months ago, we had 12,000 job openings and about 6,000 people looking for a job, because there's always somebody looking for a job. Someone gets fired, someone quits. So 6,000 is a very low number. That's how we're at 3.4% unemployment. But we had about 12,000 job openings. Now we're down to about 10,000 job openings. I remember when we got to more than 5,000 job openings. I just couldn't believe that a couple of years ago, how strong the labor market was. Well, we got up to 12 and now we're down to 10. So you're going to see some companies doing this. And of course, the financial media is eager to run any story about some company announcing layoffs. But for every company that says, hey, you know, there's weakness in what we're doing, we're going to lay off 1,000 people, let's keep a few things in mind. One is that there's a lot of other companies out there that are still hiring every qualified person that they can find. And those numbers are typically much bigger. Also, when you've had a whole lot of people getting hired, companies understand, their human resources departments understand that they may have some employees and some whole departments that they wish they could get rid of, right? And so you can have a layoff, but still come back and be hiring in other parts of the company. So layoffs exist as a tool within the legal structure and the human resources function of corporate America as a way to kind of prune some of the dead limbs off of the tree. So there's many examples where a company will announce this, and the impression created is that, oh, they're going to shrink headcount, but a year later it's actually higher. 2 years later, it's maybe significantly higher. So you got to be careful about how you interpret those headlines. We're still seeing tremendous strength in the overall labor market.
Good. Well, thank you for the question, Lee. And that wraps up all the questions we had in our queue. Eric, nice job today. And I hope everybody has a fantastic rest of your Friday and a wonderful weekend. Thank you very much for joining us today.
Thanks, everyone.